the financial papers, let's have a glance at that. What are we looking at here? Some are reporting on the strong performance of Chinese hedge funds this year amidst this market rally. Looking at industry data, Securities News says their average returns have hit nearly 25% year to date. Meanwhile, you have funds using quantitative strategies, ooh, fancy again, reporting returns here of 28%, outperforming discretionary funds.
Yeah, so certainly there's a lot of certain, there's so much animal spirits, right? It's not just the equity market, right, that we've been talking about.
Yeah.
And we're getting to a pretty interesting sort of milestone here as well. If you bring up the chart, for the first time, the amount of money pouring in and out of China in search of investment opportunities is actually exceeding the value of goods and services its trade engines generate as well. So you talked about the hot stock rally. Heavy trading of Chinese banks in terms of short-term debt have really contributed to the increase when it comes to these cross-border money movements, Dave.
Yeah, let's get the context here and what this perhaps means for efforts to internationalize the currency among other things. Tian Chen, who leads our Asia FX and rates coverage here, is here with us on sets to just help us understand. I think we'll start with a simple question here. How do all of these things actually aid China's efforts to challenge dollar dominance?
Yeah, that's a good question. So overall, the long story short, this development just means that China's efforts of opening the market have been bearing fruit, and that eventually will feed into its ultimate policy goal of internationalizing the yuan and challenging the dollar's dominance. And right now, it's also happening in an interesting window because now we are seeing this global trend of de-dollarization because people are growing concerned with Trump's policies as well as the dollar's haven status. So China actually has been stepping up the efforts of opening the markets since the start of this year. Of course, this is a multi-year process, but this year we're seeing an acceleration of this push. So overall, we're seeing China setting up the fast payment system with Hong Kong and potentially allowing more QD quota. So China is steadily moving towards the goal of letting the flows under the financial account to be more robust. So how does that feed into China's goal of internationalizing the yuan? So it creates a deeper and bigger pool of CNH offshore yuan liquidity pool in the offshore market. And that's going to allow more foreign investors to tap the CNH and to buy onshore assets. So all of that will fit into the ultimate goal. But the big caveat is that even though we are now seeing China's financial flows matching the current account trade flows, it's still falling far short behind what we're seeing in the U.S. and Japan. So in Japan, the financial flows versus current account flows, and for the U.S. can easily surpass 10 to 1, but for China it's now 1 to 1. So we're still pretty far away from the developed countries.
I mean, you mentioned about the surge in financial flows. It's still not anything compared to the U.S. and Japan, but how do you see these flows evolving moving forward?
Going forward, the market players that we talk to, they all say that it's going to continue to increase, and eventually it's going to surpass current account by a more and more significant amount. But they do say that it's going to be a very gradual process because we all know that when China does anything, it's going to be 2 steps forward and 1 step back because it really wants stability. It doesn't want crazy capital outflows in and out, and it doesn't want yuan instability. So it's going to do it very, very gradually to make sure that the quota system is in place. And China still, even after those reforms, they still have the capital controls in place. Is that they are dialing down a little bit. But when they see crazy outflows, they can easily turn the switch on and control the flows very easily. So it's going to be gradual. It's going to be a gradual process.
That's a good point. And, I mean, certainly we're seeing momentum, policy initiative. A lot of what you mentioned is also under China's control and their ability to control the pace of opening. What are the primary, whether that's external or internal, challenges or constraints that then sort of might impede the process?
I think the biggest challenge, I wouldn't call it a challenge, but a dilemma, is because the PBOC almost wants 2 things that are contradictory. It wants liberalization of the markets, but at the same time, it wants control of the markets at the same time.
Impossible.
So it kind of wants, the impossible trinity theory. So I think I would say the challenge or the dilemma there is that you always have to pace it very carefully. So that can slow down the whole process. That's why we're talking about 2 steps forward and 1 step down. Sometimes people would say, oh, is China pausing the opening up push, or is it China even reversing the push? So there are going to be doubts along the way. But overall, I don't think China is going to backpedal the whole reform, but it's just going to be very slow.